Barry, let's not bury the lead. You're looking for a pullback here. Why?
Well, when you think about it, the taper, when it comes, and it's coming, is possibly going to cause higher real and nominal yields, and that will affect the market valuation. You also might see more than just mild and transitory inflation. The second half earnings are going to be discounted by mid-year, and the second half earnings are going to decelerate, obviously, from the very easy comparisons. And then I actually think there might be a little COVID bump in the summer. People tend to go inside, particularly in the southern states, and anyone who's vaccine hesitant is probably going to be convinced after that bump to get the shot. So you look at it, it's going to be a pullback, I think, of about 10%, but probably not more with the Fed doing all this QE, which is supporting the market.
Year-end price target 3,800 over at Stifel, Barry. One of the bearish out there. It didn't start that way, of course, because when these price targets came out, the S&P 500 was not where it is right now. We've seen huge moves, Peter Tchir, over the last 6 months. And Barry pointing out in his research, we've front-loaded some huge returns from November into May. Pete, when I spoke to Rick Reeder of BlackRock on this program last Friday, he was talking about running a bigger cash position, somewhere in the mid-teens across some of the portfolios, going into what could be a choppier summer. Does that resonate with you, Pete?
Yes, I do agree that we're going to see higher yields, steeper yield curves, and that's going to put pressure on some segments of the market. I'm really thinking, we probably talked about this before, this is going to be a stock pickers type market where you need to identify the right sectors who are going to benefit from where the economy is going to be 6 months from now, a year from now. And I think we also have to really think closely about where are the tax hikes going to come? Who's going to be impacted? What sectors should you avoid? So right now, I agree that we could see a 5 to 10% pullback, probably led by big tech. I think you're going to see other sectors like the commodity sectors continue to do very well as people get this real sense that this is a global reopening, global inflation trade, and there's a lot of potential growth, especially with long-term fiscal stimulus kicking in the U.S.
Pete, you're quite bullish inflation. Why? What's different about the circumstances now that changed the economic debate for you?
I think there's a couple things. One is I think we are starting to see wage inflation. When we look at Friday's economic data, you look at a lot of other data, the total jobs weren't attractive, but the number of job openings are high. And these are a lot of low-skilled job openings. So it's not a mismatch between skills and what employers are looking for. It's about not willing to work at a certain price. And I think that salary is going to come up because companies are going to realize they're missing an opportunity cost. And then I really do believe the shift towards sustainability is going to be inflationary. Companies are heavily incentivized to switch how they produce things. They're going to switch their products to be more sustainable, and they're going to be able to pass on that increased cost to consumers for the most part. And the other part will be absorbed because their stocks will trade at a higher PE because of this ESG investing. So I think those are two things that are very, very different than we've seen any time over the last 10 years. And that's going to drive inflation much higher for longer.
Arguably, that's what we've seen in the copper price over the last several months, too. Barry, I'd love your thoughts on a couple of pieces of that argument. One being the labour supply story. The shortages we have across this economy right now, some of, not all of them, can be addressed with higher prices. Do you think the labour market is one of those issues that will be addressed with higher prices, higher wages?
Clearly, I don't see a wage price spiral, but I think that there are some areas where there are skills mismatch. Also, you have school closures, which have been extensive and unnecessary in many ways, that have kept some parents at home. And then lastly, you do have some incentives not to work, but that's spotty. So all in all, I think it's going to require a higher price to clear the labor market, and that might get passed through, or it might compress margins, making that 32 times multiple on normalized operating earnings, 10-year average inflation-adjusted real operating earnings, more unsustainable. There's a lot of cognitive dissonance in the market. A high PE is going to require a long-term view, but the policies that support the high PE aren't viable long-term. So we have some problems with the market valuation and the inflation outlook.
And one of those policies that supports the higher PE, Barry, and you're pushing out against right now is yield repression, rather. I get my words out. Barry, what is it about policy that you're anticipating? How do you think it will evolve in the summer that's going to lead to yields going the other way?
QE is increasingly counterproductive, not just in the pricing at the short end, but also for bank lending and creation of reserves. We want lending. We don't want the Fed creating reserves. So the Fed is trapped by its own easy policies due to their the political climate in Washington. You know, we have a somewhat radical Keynesian MMT-funded populism right now, and the Fed is trapped in that. It can't afford to give up its independence, but can't afford to fight it too hard. So they're really between a rock and a hard place. So I would think that you would have to have some phase back of the Fed's QE before the market would adjust lower.
Really interested in that word radical. That's a political assessment of what's happening in DC right now. But Peter, looking at the market, I don't see anything radical about the bond market, 157 on 10s. And the number one question we asked last week going into that payrolls report, you take out Friday, the only question that I heard anyone ask in the bond market was, data's great, why aren't yields higher? Pete, what was your reaction?
I think right now everyone's focused on when the Fed will hike. And I think they're not going to hike anytime soon. I think what we have to start talking about is the terminal rate. How high will yields have to go to slow down inflation once they let it out? That's a conversation that's going to take place over the coming weeks or months. And also, while there's talk about them tapering, I think there's also a risk that they do an operation twist. They do something to suppress that long end of the yield curve. So we're in a very micromanaged yield environment where the Fed is looking very closely at it. So I think people got very short, they got caught, and now we have to be cautious that the Fed doesn't fight this yield or move to higher yields, but I do think we get it. I'm expecting the 10-year to hit 2% this quarter.